Today we are joined by Tim Johnson, the Portfolio Manager of the Nikko AM Tyndall Australian Share Concentrated Fund. Tim, can you tell us a little bit about your background?
I started my career in chartered accounting. I realised quite early on that that wasn't the career for me, but despite that I finished the qualification and soon afterwards was able to move into the equities team at what was then Tyndall Equities. So I've been with the equities team here since 1999. Over that 17-year period, I've covered a number of different sectors in the market, which has been very useful in the latter part of my career, which has been managing the concentrated equity strategy alongside Jason Kim since 2007.
Tim, you have a large team in place. Can you explain how the investment team interacts and what are your specific responsibilities?
We have a very large research team here at Nikko. The reason for that is we want to do detailed and in-depth research on each of the stocks under coverage because we are looking for insights that perhaps the market has missed. So each member of the team, with the exception of our dealer, has a list of stocks which they are solely responsible for. They provide research and evaluation on each of those names. As a team, we discuss the outcome of that research, and from that we form a return expectation for every stock under our coverage universe. My role in the team, in addition to co-managing the concentrated strategy, I have responsibilities for the healthcare sector, the agricultural sector, oil and gas, and the integrated utilities.
Tim, how are the investment team aligned with investors in the fund?
Alignment between clients and staff is very important at Nikko. First and foremost, integrity is a key value here, and we won't tolerate individuals acting in anything but the best interest of clients. In addition to that, our remuneration structures lead us or have incentives aligned with clients. Firstly, our annual bonus, the biggest component of that, is a function of client returns. Secondly, with the exception of our junior analyst, everyone in the team has equity in the business. Obviously, therefore, we are motivated to ensure that clients are happy and stay with us in the long term. And the best way to have a happy client is strong investment performance.
Can you explain to investors the investment objective of the fund?
The investment objectives are to deliver a robust and growing income stream, as well as capital appreciation through the identification of mispriced stocks.
Can you talk through the investment philosophy behind the strategy?
At Nikko AM, we are value investors. We believe that the market is sufficiently inefficient that we can identify mispriced stocks that will deliver excess returns over time. In addition to that, obviously the value anomaly is well recognised, and in both Australia and in the major international markets, it's been identified that value can outperform growth by about 2% per annum over the long term. In addition to that, the concentrated strategy delivers a couple of other market anomalies. Firstly, the low volatility anomaly. It's well recognised that lower risk stocks tend to outperform in the long term, and by virtue of the yield bias that we incorporate into this portfolio, we tend to skew towards more defensive and lower risk stocks. In addition to that, the concentrated nature of the portfolio provides additional returns. There's good academic evidence that supports concentrated portfolios and evidence that they will outperform more diversified funds in the long term. And the reason for that is twofold. Firstly, being a concentrated fund, you've only got your best ideas in that portfolio. And secondly, by limiting the number of names in the portfolio, you prevent diversification, which is a phrase coined by obviously the famous investor Peter Lynch, suggesting that investors who could continue to add names to their portfolio just dilute returns.
You manage a highly concentrated portfolio between 15 to 20 companies. How do you select stocks for the portfolio?
The output of our research process is a list of total return expectations for each stock in our coverage universe. This portfolio is designed to purchase those stocks with the highest potential total return, in addition to having a minimum grossed up dividend yield of 4%.
You manage a concentrated portfolio. How do you manage this risk?
We manage risk in a number of different ways. Firstly, because the portfolio is highly concentrated, we are very conscious of avoiding concentration risk. So we do ensure that the portfolio is adequately diversified across a number of different sectors of the market. In addition to that, the product design limits the exposure in any one industry sector. In addition to that, we also utilise a portfolio management tool, BARA, which looks at the risks inherent in the portfolio as well as examining the portfolio relative to the market. So we look at how the portfolio is set against the different factors that we know drive equity markets in the longer term. And then finally, we rely on our experience and judgment to a great degree. We will adjust the portfolio where we see circumstances changing that undermine an investment thesis. So if one of our core assumptions that undermine any investment is breached, we will cut or exit that position and review the position from a position of neutrality.
Does a high conviction approach mean a more volatile return for investors?
In the short term, the concentrated nature of the portfolio can mean that the portfolio is more volatile than the market. That said, we fill the portfolio full of lower risk stocks. So because of the yield bias in the portfolio, we skew towards more defensively oriented names. But as a consequence of the concentrated nature, there are periods of time when the portfolio can be more volatile.
Does the portfolio remain fully invested at all times?
We are generally fully invested. We do have the capacity to go to a 10% cash position, but the only time I can recall that we were anywhere near that was as the GFC was unfolding. We took a lot of risk off the table and held it out of the market as the market capitulated.
What are some of the key features of the strategy and what's the recommended time frame for an investor?
Obviously, equities are a long-term investment in their own right. This is a strategy which can look very different to the market at periods in time and delivers a different return profile to the market. As a consequence of that, we think investors should look at this portfolio over a business cycle, which is around 7 years.